Welcome to Lesson 4. Today we're looking at how markets actually move. On the Bitcoin daily chart on your screen, why do some days go up and some days go down? The answer comes down to three things. First, supply and demand, then the order book, and finally how trades get filled. Once you understand those three, chart moves stop looking like magic. Drop a comment and tell me whether you're more focused on stocks or crypto right now. Prices rise and fall for one core reason, a tug-of-war between people who want to buy and people who want to sell. Think of a coffee shop. When the line is out the door, the shop can raise a latte from $3 to $4.50 and people still buy. When the place is empty, they may have to drop it toward $3 just to move cups. Every candle on a chart is a record of that day's fight. On this Bitcoin daily chart, spot the up days, buyers winning, and the down days, sellers winning, for yourself. Textbooks say news, earnings, and interest rates, including Fed moves, shift that balance. In reality, countless forces are pushing every second. And markets do not always follow the headlines. Prices can stay unpredictable. Real trading happens in the order book. Think of it as a menu. Bids, buy orders, and asks, sell orders, stack up in one view so you can see who's willing to trade at what price. Bids stack from the bottom up, starting with the highest price buyers will pay, for example, buy 100 at 68,900. Asks stack from the top down, starting with the lowest price sellers will take, for example, sell 100 at 69,100. A trade completes where those two meet, where I'd buy at that price and I'd sell at that price finally agree. The gap between the lowest ask and the highest bid is the spread, simply the difference between the buy side and the sell side. The tighter that gap, the faster and cheaper trading tends to be. Bitcoin on this chart trades heavily, so the spread is usually very tight. When a buy price rises to meet or cross a sell price in the order book, the trade completes. That moment is called a fill. Fills follow a fair order. First, higher buy prices go first. Someone bidding 69,000 beats someone bidding 68,900. Second, at the same price, earlier orders go first, time priority. You might not get your full size in one shot. If you try to buy one Bitcoin and only 0.3 fills, the remaining 0.7 stays working as an open order. There are two main order types: market orders, buy or sell right now at the current quote, and limit orders, wait until your chosen price. For beginners, limit orders are usually friendlier. You wait patiently and cut down on surprise slippage. Liquidity means how easily, quickly, and cheaply you can buy or sell without moving the price much, how smoothly money flows through an asset. Bitcoin on this chart, or a large cap like Apple, tends to trade in huge daily volume. Even a sizable order often moves the price less. By contrast, a thinly traded small cap can jump hard on a small buy. Those assets are called low liquidity. Low liquidity can leave you unable to sell when you want out. That is liquidity risk, and it matters when you invest. If you suddenly need cash, a tiny stock may not sell cleanly. That is why keeping a solid share of highly liquid assets is wise. Trading hours differ by asset. U.S. stocks on the NYSE and Nasdaq run roughly 9:30 a.m. to 4 p.m. Eastern, about 6.5 hours of continuous regular trading, with no midday lunch break. If you live outside the U.S., that session may fall overnight for you. Bitcoin on this chart, though, trades 24 hours a day, every day of the year. Volume and volatility often peak in the first 30 minutes after the open and the last 30 minutes before the close, when pros and institutions are most active. Outside regular hours, you can still stage orders ahead of time. Those pending orders can trigger automatically when the session opens at your chosen price. 24-hour markets like crypto let you start anytime, which also means you need a real sleep and time management plan. Lesson 4 in one pass. Price moves as a tug-of-war between demand that wants to buy and supply that wants to sell. The order book is where that tug-of-war happens. The tighter the spread, the lower the trading cost. Fill priority is fair. Higher prices first, and at the same price, earlier orders first. Low liquidity makes selling hard. Keep highly liquid assets ready for emergencies. In Lesson 5, we'll dig into what a stock actually is. This course is for education only, not investment advice. Every investing decision is your own responsibility.